This is Jim Martens, Senior Currency Strategist here at Elliott Wave International, and today is Friday, February 15th. We've started off with several videos with this chart of different corrective wave patterns. And in past videos, we've talked about this first one here, a zigzag. We've talked about a flat, and I believe we've covered a triangle. The one we've shied away from is this final one, which is actually called a combination. And this is the one that throws most people, and it really doesn't need to. And so what I want to do today is talk a little bit about this pattern, what it is, and then I'm going to show an example. And in that example, it's going to show you how I originally thought we simply had a zigzag correction, but then later as it developed, the wave count had to change as a result of price action and how we resulted in a combination correction. At least that's my thinking today. So with that, let's first start with what this combination is. Really, it's just two corrective patterns connected by a third corrective pattern. So what happens is you could have, in this example, there's a zigzag of 5, 3, 5 for a zigzag, and the correction could be done there. But in this idealized example, the market recovered in only 3 waves and did not come close to the previous top and started falling again and fell in 5. So once we took out this prior low, something else was happening. Obviously, this wasn't all of the correction. There was more to come. So we throw an X over the top and look for another one of these corrective patterns. And it can be either, it could be another zigzag, could be a flat, could be a triangle. And that's true of the X wave as well. It could be any of these other corrections. So really what a combination is a sequence of independent corrective patterns that are linked together. So with that, let's move into the example I chose. And this is of dollar yen. And just so you have some perspective, dollar yen had fallen from around 114.65 down to just below 105. And when this chart was issued, which was back on Feb 1, I thought there was a 3-wave rally into just shy of 108. It looked like a fairly impulsive decline, clearly another correction, sharp decline, maybe a flat. I kept drawing lines over where the market should not go if the larger trend is back in force. And I was confident at the time that the larger trend was to the downside. So I had some, from the larger chart picture, I was expecting rallies to be 3s, declines to be in 5s. So with 3 waves up, why not just go ahead and say, okay, that's the top of the correction. Here we go back to the downside. Well, as you can see by the 12th, so earlier this week, the market had gone sideways. Here was that original 3-wave move from near 105. This is where the prior chart left off right here. So we never could break beneath this low, and clearly not back below 105, and the market kept consolidating. So I said, okay, what other pattern could this be? A triangle came to mind. 3 waves up for A. This is a 3 of some sort in B, a 3 of some sort. There's 3 legs in this, up, down, up. So that would be C. And then this was a 3, a down, a sideways down. So that's a 3. That would be D. And a rally in E. And I like this situation here because I know where the pattern is wrong. I know where my outlook would be incorrect. If this is a triangle, we have to hold these highs. So I know what my risk is, and I know what my reward would be. If the triangle is correct, we're getting ready to thrust to a new low beneath 105. So when I look at risk reward, it's quite favorable. So let's see what happened this week since the 12th. Here's the updated chart. As you can see, we broke out above these previous highs in a sharp move. And when that happened, I wrote to subscribers that just because the market breaks out isn't necessarily bullish. And I wrote that before the breakout occurred because the risk point here at 107.96 was so close to the market at the time. I mean, I'm always looking over my shoulder. If I'm wrong, what is happening? What could be happening? So I knew that if we went to a new high, I'd still think the whole move was a correction. I mean, it started with a three-wave movement and then a three-wave down. So if we were doing a combination correction, I would be looking for another three-wave movement. So we go back to the example. Here's the first three up to just short of 108. There's a three-wave correction, which I put the X underneath the low. And I started thinking, this clearly isn't impulsive, but how do you label it? And I thought, okay, so this is an A. 1, 2, 3, 4, 5 for A. I can count a triangle. A, B, C, D, E. That's the B wave. And then a rally in C. And what's interesting here is the two zigzags are within 2 pips of being equal. So from the X wave, this ABC, or more likely ABC, is within a couple pips of equaling the original ABC off the low. Now, I'm not showing it here, but I mentioned before, this decline into the low began around 114.65, and the 318 or the 382 retracement lies also within pips of this equality measurement. So it was quite a strong cluster, target cluster, resistance cluster here. And so far we have seen the market fall. Now this chart was taken on the 14th. By the 15th, we've traded as low as 107.30. So we're actually down here as I'm taping this. So we still don't know if the count is correct, but clearly with no other perspective of knowing that this market came from the 114 handle down to 105, and then looking at a chart even without labeling it, just seeing this mess, I would anticipate that that will prove correct. And now having looked at the internals and being able to count this combination, which is really 2 zigzags in this case, ABC, ABC, 2 equality, to the 382 retracement of the prior decline, I think you make a strong case as that's a correction. So I want to show this example today because this is a pattern. The combination is a pattern that we often shy away from, and it often confuses people. In fact, when I'm working with people when they're just starting out with the wave principle, this is probably the most corrective, the most confusing corrective pattern. Counting 1 to 5 doesn't need to be very difficult. And if you just want to keep it easy, you could just do that. You just count 5s, and then you count a mess against that 5 to the previous 4th, and then continue on up to the next degree. It's when we get into corrective patterns that it gets more difficult, and that's particularly true when we get into linking corrective patterns together. So that's why I picked this subject for today, and I hope this sheds a little bit more light on it, shows that it does not have to be so difficult. And also, we've talked about how the wave count can change as we have more information. As the market continues to unfold, there's nothing wrong with changing the count. We have to adapt to what the market is doing, because at the end of the day, all that matters is price. So we have to be able to think ahead. If the market moves to levels we didn't think it should, then what would be the count then? How am I going to react to this? And in this case, we knew, one, not to chase a breakout, because we already had, from a larger perspective and from the wave count internally, already had the idea that this whole thing would prove corrective anyway, and we had targets that weren't that far away. So let's leave it there for today. I'm sure we'll touch on this subject again when we get another good example. So if you have any questions about this, or any ideas or thoughts, comments, as always, please send them in. Thank you.